Gold is being dumped right where it is supposed to look strongest. And that is exactly why this setup is so dangerous. The market is acting like a breakout, and a betrayal can happen at the same time, even though those two things should cancel each other out. Because here is the contradiction nobody is pricing correctly. If institutional desks really believe gold can stretch toward the $4,700 zone, why would visible liquidation pressure start showing up near that same anchor, while retail investors are still waiting for a clean all clear? That is the open loop for this video. And by the end, I am going to show you why this may not be a bearish call on gold at all, but a warning about who gets shaken out before the next repricing move. What makes this story urgent is not a vague macro headline. It is the combination of named institutional positioning, visible liquidation behavior around the clearest number in the niche, and the widening split between Eastern physical accumulation and Western paper hesitation. In the East, buyers still treat pullbacks as inventory opportunities. In the West, paper markets still behave like price itself is the truth, even when physical flows keep saying the benchmark is late. So when people hear Goldman and liquidation in the same sentence, the instinct is to jump straight to panic. I think that misses the real signal. The better question is whether this pressure near 4,700 is meant to cap enthusiasm, improve entry, or force weak hands out before a larger move that physical buyers are already preparing for. Start with the catalyst. The slot brief is centered on institutional positioning and liquidation pressure near $4,700 gold. That matters because this is not a random price level pulled from a thumbnail. It is a psychological ceiling, a media headline number, and a retail hesitation zone all at once. Big institutions understand that round numbers do emotional damage. They know that if gold moves strongly toward that zone and then stalls, retail interprets the stall as proof the move was fake, while professionals can use the same pause to rotate, hedge, or reload. This is where East versus West becomes critical. In the West, especially through futures, ETFs, and derivatives exposure, gold is often treated as a tactical trade. Positioning can change quickly because paper claims are easy to add and easy to remove. In the East, especially through bars, jewelry savings, sovereign diversification, and direct physical accumulation, gold is often treated as stored labor and long-term monetary insurance. That difference creates a recurring distortion. Western paper price action can look weak, even while Eastern physical appetite stays firm or gets stronger. What this means for you is simple. If you are looking at a 50-ounce gold equivalent bag and waiting for a perfect Western confirmation signal, you could be waiting through the exact window when physical buyers in the East are absorbing supply. On a 50-ounce position, a $200 move per ounce is a $10,000 swing. Even a 10-ounce holder is looking at $2,000 of repricing, and a 5-ounce holder is still looking at $1,000. The paper chart may look indecisive, while your real-world cost of waiting gets very concrete. Now let us get more specific about the betrayal frame, because it has to stay data-backed. Named institution angles work when they describe behavior, not when they drift into fantasy. What we can say with confidence is that large institutions do not need to announce a bearish thesis to create bearish conditions in the short term. They only need enough visible liquidation or enough positioning pressure to change sentiment. Once sentiment changes, the Western paper market does part of the work for them. Stops get hit. Momentum traders reverse. Retail viewers hear that funds are selling and assume the smart money knows something terrible. But that assumption can be backward. A visible sell program near a major upside anchor can mean at least three different things. First, it can mean risk management after a strong run. Second, it can mean short-term suppression or cooling to avoid disorderly upside. Third, and this is the most important possibility, it can mean stronger hands are trying to buy future ounces cheaper by forcing weaker hands to sell their exposure now. Retail usually sees all three as just one thing: bad news. Physical accumulators usually see them as different species of opportunity. Watch how the East-West split changes the interpretation. If liquidation hits in New York or London paper markets, Western commentary instantly becomes about failed breakouts, exhausted momentum, and how gold moved too far too fast. Meanwhile, Eastern desks and buyers do not have to accept that narrative. If premiums, import demand, central bank accumulation habits, and wholesale appetite remain firm, then the paper dip is not the whole story. It is just the story most visible to Western screens. What this means for you is that ounces matter more than opinions. If you own 1 ounce, the difference between being shaken out at a $200 dip and holding through a $400 rebound is $600 of outcome between the low and the recovery path. If you hold 10 ounces, that same sequence becomes $6,000. If your target framework is 50 ounces of gold equivalent, every $100 per ounce is $5,000. That is why institutional behavior near a number like 4,700 matters. It is not abstract. It directly affects what your stack is worth and whether you are reacting to paper emotion or physical reality. There is another reason this setup has urgency right now. The slot brief specifically says named institutional betrayal still outperforms generic alerts, and 4,700 remains the cleanest number anchor in the niche. That tells you something about audience psychology, but it also tells you something about market psychology. Markets gravitate toward narrative magnets. Round targets become magnets because everyone watches them. Once everyone watches them, institutions can use that attention. A clean breakout above such a number becomes crowded. A dramatic rejection below such a number becomes terrifying. Both outcomes are emotionally useful to professionals who know how to trade around crowd behavior. And here is the hidden truth most retail gold commentary skips. The West is obsessed with whether paper gold deserves a higher price right now. The East is more concerned with whether physical gold is available at a price that still looks cheap relative to currency erosion, reserve diversification, and long-duration distrust in fiat systems. That is a profound mismatch. Western traders ask whether gold is overextended this week. Eastern accumulators ask whether the monetary regime is giving them another chance to add hard assets before the next policy mistake. Those are not the same question, and they do not produce the same buying behavior. If you are getting value from this breakdown, hit like here because it tells the algorithm this channel should keep making data-backed gold content instead of price spam clips. The reason I say that now is simple. We are at the point where the story stops being a headline and starts becoming positioning math. Think about how suppression or lag works in practice. A paper-heavy market in the West can create the appearance of abundant supply because contracts can expand faster than bars can move. That makes rallies look easier to fade and dips look easier to manufacture. But physical accumulation in the East imposes a different discipline. Bars leaving the market are bars leaving the market. Jewelry demand, sovereign reserves, and wholesale hoarding are not just numbers on a screen. They reduce float in a way paper can temporarily hide but cannot cancel forever. So when liquidation pressure appears near a high-profile target, the crucial question is whether physical metal is actually loosening up or whether only paper confidence is weakening. If it is just paper confidence, then Western markets may be suppressing a signal that Eastern buyers are already confirming through action. That is the essence of this channel's framing: physical accumulation in the East versus paper suppression or lag in the West. What this means for you is that bag size determines emotional vulnerability. A viewer with 2 ounces may shrug off volatility. A viewer with 20 ounces feels every manufactured flush. A viewer building toward 50 ounces of gold equivalent has to treat these events as inventory decisions, not entertainment. A $150 paper hit on 50 ounces is $7,500. If that flush allows physical buyers to keep accumulating while Western holders panic, then the real transfer is not just price, it is ownership. Now let us deal with the credibility peak, because this is where people usually ask whether we are forcing a pattern. We are not saying every Goldman-linked liquidation signal means immediate upside. That would be sloppy. We are saying visible institutional pressure near a major anchor should be read in context with who is still buying physically, where accumulation is strongest, and whether the weakness is showing up in metal flow or only in paper positioning. That is a much tighter claim, and it is the one that actually matters. Here is the pattern professionals understand. Markets often punish late retail participation right before the move retail was waiting for. They do it by creating an impossible feeling. Price is high enough to feel dangerous, but still not high enough to feel confirmed. Then a visible liquidation event gives nervous holders a reason to exit. That exit becomes liquidity for stronger hands. If Eastern physical demand stays firm during that period, the supposed warning can end up being a transfer event. That is why I want you to pay attention to the language around this catalyst. If headlines say funds are selling near 4,700, most people hear the first half and ignore the second half. Near 4,700 is the point. Institutions are not accidentally active around emotionally loaded numbers. They know exactly where conviction is weakest. They know retail is waiting for permission. They know a sharp reversal around a major target can do more damage to confidence than a slow drift lower ever could. If you want more of this style of analysis, subscribe here because this is the part most channels skip. They either scream moonshot or scream crash. The real edge is understanding who is using volatility, who is trapped by it, and why east-west flow divergence keeps exposing the limits of the Western paper narrative. Now let us come back to the open loop from the beginning. Why would institutions show liquidation pressure near a level they supposedly believe gold can eventually reach or exceed? Because the goal may not be to deny the long-term thesis. The goal may be to control the path, improve positioning, and decide who gets to stay in the trade. That sounds harsh, but it is how large capital behaves. They do not just care about destination, they care about entry quality, optics, counterparty emotion, and the ability to buy discomfort from people who cannot tolerate ambiguity. This is also why the East matters so much in 2026. If physical buyers in Asia and other accumulation-heavy regions continue treating dips as opportunities, then Western paper weakness becomes less a verdict and more a delay. The East accumulates ounces, the West debates candles, the East takes delivery or locks in real metal. The West often rotates between narratives. One side is trying to own the asset, the other is still trying to interpret it. What this means for you is deeply personal. If your long-term goal is 50 ounces of gold equivalent, then your biggest risk may not be buying a little too early. It may be getting talked out of your plan by a paper flush engineered around a headline number. If you have 5 ounces, ask yourself what a $300 per ounce move means. That is $1,500. At 10 ounces, it is $3,000. At 50 ounces, it is $15,000. Those are real family level numbers. That is why I want you to think in ounces owned and ounces desired, not just in viral price targets. And this is where I want your comment. Tell me your bag size target, whether that is 1 ounce, 10 ounces, or 50 ounces of gold equivalent, and tell me whether you think Western paper markets are lagging Eastern physical demand right now. That discussion matters because the biggest mistake retail makes is assuming everyone is playing the same game. They are not. So here is the resolution. The contradiction is only impossible if you think all selling is bearish. Sometimes liquidation near a major upside anchor is the mechanism that clears the path for the next move by transferring exposure from nervous paper hands to patient physical hands. Goldman-style pressure near 4,700 does not automatically mean gold is finished. It can mean the opposite. It can mean the market is being forced to look weaker in the West, precisely while underlying conviction stays stronger in the East. That does not guarantee a straight line to higher prices, and it does not remove volatility, but it does change how you interpret the catalyst. Instead of asking, why are institutions selling, ask, who is buying the weakness in what form and in which geography. If the East keeps accumulating real metal while the West keeps pricing through paper hesitation, then the lag is the opportunity. And if that is true, the most expensive mistake over the next phase may be confusing a controlled institutional betrayal with a broken long-term thesis. Watch the flows, watch the premiums, watch the physical response, and watch who benefits when retail gets scared near obvious numbers. That is where the hidden truth usually sits.